Okay. Okay, great. I'm glad you mentioned the stable coins because I had a ton of questions around that. It sounds like they haven't really sort of shaken your fundamental case for stable coins because you're less into the algorithmic ones, which are the ones that have gotten in trouble for the most so far, right?
Yeah, I think so. Basically, what fiat collateralized stablecoins do is they make the peer-to-peer side uh, tradable, while the custodian's still centralized. And there's two main use cases for them. One is that on these offshore crypto exchanges, people use them as a unit of account for trading. But I think the more interesting use case is that in emerging markets and frontier markets and other countries that are having currency problems, if you try to hold dollars, in a Lebanese bank or an Argentine bank, they can easily be confiscated from you. They can be converted to the local currency and then taken from you. And of course, it's risky to just hold dollars under your mattress.
Right.
And it's also hard to get. And so, stable coins are interesting because people in developing countries have a way to get dollar exposure in a way where even though it's centralized because the custodian is centralized, the custodian is outside of that country's jurisdiction. And so if you're an Argentine investor, you know, having some stable coins can be a useful part of a portfolio. And it's a way to deal with, currency problems. That's obviously less volatile than Bitcoin. Now there are risks around the collateral, and there's two main ones. There's Tether, and there's also USDC. USDC's 100% cash and T-bills. Tether uses a portfolio model, and so investors can choose which one they want to have exposure to. And so it's one of those things where I think that technology has legs to it, but of course there is regulatory risk. I think over time they're going to be pressured to be more and more in that entirely T-bill model, entirely cash model. And I also think it's large countries could go after them and make them basically be operated like banks. And so I think we're going to see regulations tighten around them. But that it's pretty obvious why people in developing countries tend to use them. And I think the trap that people fall into is to realize that just because something claims to be a stable coin does not make it a stable coin.
Right.
And so algorithmic stable coins have had a long history of failure. And the problem with this whole Terra Luna one is that they were giving people artificial high yields, 20% yields that were funded by VCs. They were clearly artificial to draw people in. And then it blows up. They're like, well, it was an experiment. It's just experimental technology. Well, you were drawing people in to an experiment with 20% artificial yields. So that's more than just an experiment. And so basically what they were trying to do was operate like an emerging market central bank, but without capital controls and without the ability to tax a real economy. And so algorithmic stable coins are kind of inherently a volatile and dangerous area.
All right. Well, I really appreciate that context. I will have to have you back on at some point to give you a lot more room to run to talk about the nuances involved in both Bitcoin, stablecoins, and what else about the blockchain ecosystem that you'll like. Sorry to make you cram this into the very end here, but that was a great, concise answer. All right. Well, look, right before I ask you where people can go to find out more about you and your work, Lyn, we talked about you just gave a great sort of litany of the assets that you think could fare well given the current environment that we're in. Are there any other sort of general bits of advice that you would offer people given the type of future that you see coming here? For example, I'll make another plug for it here, but I've written a guide called the Guide to Layoffs, the Layoff Survival Guide, which you can get at wealthyon.com/layoffs. So if you haven't gotten that already, folks, go get it. It's free. But just trying to give folks, some tips of things that they could do today that should their job become at greater risk tomorrow, they're going to be a little bit less vulnerable, a little bit better prepared based upon steps they've taken today. Whether someone's a homeowner or whatever, are there any just sort of general bits of advice that you counsel people to start at least, thinking about right now, given the fact that a recession may be in the cards here?
Well, I've been a proponent of minimalism, right? So basically not being bogged down by consumerism, right? And that, of
Mhm.
course, can mean different things to different people, but basically focusing on what's important in life. Focusing on what actually makes you happy versus keeping up with your neighbors or things like that. And so I do think this is an environment where you want to have, your income diversified or as steady as you can get it, your expenses well contained, at least your kind of ongoing mandatory expenses rather contained so that you're flexible to deal with hits to your income. And I think, it's good. One way I described it, is that supply chains are optimized for low inventory and just-in-time delivery, and so it's kind of up to the households in order to have a buffer. And so that doesn't mean you have to have like a, you don't have to be like a full prepper with like a bomb shelter. But I think it means that it's good to have a stockpile of things that you need on a regular basis, whether it be food, whether it be paper products and things like that, but certain medicines. I think it's useful for consumers to have a buffer of supplies for things going forward, especially in challenging economic environments.
Great, very well said. I like all of those. Diversified incomes, contained expenses, sort of your minimalism, like just focus on the fewer things that bring you joy and don't worry about, the trappings of everything else, but also the buffer. And obviously, from a job standpoint, having a 3-month or even a 6-month, kind of stash of savings just to keep you going in case you lose your job. But also, as Lyn said, just key essentials, right? And you don't have to go out and buy them all tomorrow. You can buy them incrementally over time so that you're doing it within your household budget. But all that stuff makes just great sense. All right, so Lyn, for folks that have really enjoyed this conversation, would like to follow you in your work going forward, where should they go?
I'm at lynalden.com. Mostly it's free material, free newsletter, public articles. I also have a low-cost research service, and I'm on Twitter at Lyn Alden Contact.
All right, great. And as somebody who is a regular consumer of Lyn's contact, it is some of the absolute best out there, folks. And a lot of it is free. So definitely avail yourself to the free stuff. And if you like what you see there, I can't recommend her premium service highly enough. All right, Lyn, well, look, thanks so much for coming on. Folks, I'm going to ask Lyn her origin story in our bonus video. So to watch that, just go to wealthion.com/Lyn. That's LYN. Lyn, thanks so much for giving us so much time. You've been a great soldier through this, especially just having come down with COVID. I can't tell you how much I appreciate that. Really look forward to having you back on the channel soon.
Thanks for having me.
All right, well, now's the time on the program where we bring in the lead partners from New Harbor Financial, one of Wealthion's endorsed financial advisors, to do a little Monday morning quarterbacking to what Lyn just said, but also talk about what the markets are up to since last week. Mike, John, great to see you guys again. Mike, why don't we start with you? Got a number of questions here for you regarding what Lyn said, but what struck you as sort of most memorable from that conversation?
Yeah, thanks, Adam. A lot of talk about monetary policy and central banks still. Of course, that is the only game in town. It remains the only game in town and probably will be for quite a while. Lyn pointed out a number of salient points, I think, just kind of looking through my notes. She said that for the last 30 or 40 years that we've under invested in real world systems. And so therefore, we have a shortage of real things, commodities, energy, and whatnot. And so, that's kind of what we're facing today and what we're likely to face in the next 10 or 20 years. It's one of the reasons why we like commodities and real things. Not to mention that they're severely undervalued relative to financial assets, which are severely inflated. So the future probably should be a good place to invest in real assets, i.e. commodities. She also said that we're in a economic deceleration combined with stagflation. And, she likes defensives, again, real things. She even mentioned some healthcare in there too, but energy and other commodities make sense here. She also talked about the inflation problem, which has become a real issue, right? We had COVID and we printed something like $6 trillion of money and kind of threw it into the system and said, spend it, all while people weren't traveling or going out and that type of thing. And it's created real inflation problems. And now we have an issue. It's become a political issue. Inflation has. And she mentioned Paul Volcker, certainly a hero of mine that tamed inflation in the 80s. And he came in and raised rates and broke the back of inflation. And she pointed out a very important point, that we don't have the same latitude as that anymore. There's so much more debt in the system. The total federal debt is something like 30 trillion. And it was, I'm guessing maybe 1 trillion back then, if that, probably less. And so Paul Volcker could come in and raise rates and break the back of inflation. If we were to raise rates significantly now, it would cause a depression with 30 trillion plus of debt on the balance sheet. So the Fed can't do that. The Fed can't do that. And so we're probably facing permanently higher inflation going forward. And that's another reason why it supports the idea of investing in real things. So I think I'll stop there. But the real point is that the Fed is in a box. We have inflation. They can really only jawbone and try to talk it down, because if they raised rates too much, it would cause an absolute depression / crash. That could happen anyway, but it's going to be more of a tactical, kind of a slow move versus what Paul Volcker did.